Apes and ape bets, hedge funds have a massive problem. And we're going to go over that problem here in this video. And I don't think a lot of people fully realize this or understand this. So hopefully we can make a breakthrough here in the community. Let's dive into it. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. So if we look at what's recently happened with AMC stock, it's no surprise the stock has been falling. And it's been falling for really one reason and one reason only. Earnings were good. Things have been relatively positive with AMC. You really haven't gotten any bad news. It's been the option activity. Now, I guess you could say hedge funds have a lot of problems. Not really just one in particular. There's a lot of problems with being short on AMC stock right now. Number one, this is all options, right? If we look at what happened on Friday, AMC stock was down 1.28% in regular trading. The stock was up 0.85% in after hours. This is the trend consecutively. If you are red during the day, 9 times out of 10 recently, you have been green in after hours. And what does not trade in after hours? Options. Options don't trade in after hours. So you don't see as much of that hedging from market makers taking place in after hours. So I think under the surface here, there still is a lot of buying pressure. There still is a lot of people that are bullish on AMC stock, even as we see from the 13F filings coming out from banks, some hedge funds, some institutions. Some of them are increasing their positions by 100, 2, 3, 4, 500%. JP Morgan increased their position is like 600% on their call position. And I believe, was it Citi or Bank of America? One of those is very positive on AMC and has increased their position by hundreds of percents. The other one did not. But it's the same overall trend here. They're using the options to bet against AMC. And we've talked about this before. We've looked at this, and I'm sure in this video we'll look at the options that took place on Friday. They're all the same. They're all targeting deep in the money puts. You're not really expecting, at least from these trades, to see a big fall. It's more or less trying to suppress AMC's price here in the short term. So on one hand, when there's so much option activity that is negative, that is shorting the stock, essentially synthetically shorting AMC, once you do get a rally, you're going to see a massive de-hedging from market makers as some of these puts do go out of the money or just go up in value. These in the money puts don't have to go out of the money to get hedge funds to de-hedge. It's all based on the price of these options and the break even on these options. Hopefully that makes some sense. So I think that is one problem. Another problem I think hedge funds have is apparently, take it for what you want. If you believe the data is correct on AMC, which I don't think a lot of us do, but if you wanted to entertain that, AMC's short interest dropped from 26% to 21%. And why does that signal to me hedge funds have a big problem? Well, when the short interest drops in a stock that much in one report, that's usually an indication of good news to come. That's usually an indication of a short thesis deteriorating. Because why would you cover on your short position? This 5% of the free float, which was apparently covered after April 28th, I mean, the stock, AMC stock, went from $5.55 per share to $6.11 per share. If that's going to squeeze you 5% of shorts out of their short positions, either liquidity is really drying up and they were forced to cover. And obviously cost of borrow fees being the way that they have in 2023 has definitely not helped that. So that's a possibility. But probably most probable is that good news is likely coming. And someone wanted to get out of their short position. Maybe it was just a couple firms. That's always a possibility. We know a lot of these guys have very large short positions on AMC. Unfortunately, hedge funds don't have to report their short positions. They have to report their long positions. They have to report their calls and their puts, but they don't have to report their short positions. Who knows why at this point, but they don't have to. So we don't know the exact sizes of some of these short positions. They could be massive, or they could be just a lot of guys with small short positions. That's always a possibility as well. But from the way that I see it, being on Wall Street for a while now, needless to say, you don't see short interest fall like that as the stock has only went up. I mean, what kind of gain was this? Like, this gain was nothing. From the low on April 28th to the peak, that was a gain of 11%. And you're telling me short interest went from 26% to 21%? There's good news coming if that data tells you anything. Or maybe liquidity is just so bad that they had to cover on their short positions. And then I would say that's also a positive thing. I think that would indicate a short squeeze is a lot closer than a lot of people think. Give it a little bit of time. So I think these are two big problems that hedge funds have right now. Another big problem that I see in line with the liquidity potential problem that we're seeing with hedge funds is the concentration in this market. Now, let me just say this right now. You have never seen concentration in the way that you are seeing it right now. Most stocks are nowhere near their highs, nowhere close. I've said this statistic before, and it's even more true now. Over 50% of stocks are at their October lows or under them. A lot of stocks have done very poorly. But your largest stocks in the market, really if you look at your NASDAQ 100 stocks, but really your large tech names, they have done all of the weight, all of the move in the index. So on a face value, some analysts, some people say the markets have been great in 2023. This was the start of the bull market again. And you don't get a bull market. You've actually never seen a bull market start and last with sectors like banks massively underperforming, or cyclical names. Your cyclical names, call it a retailer. That is a cyclical company. Think of it like the cycle of the economy. If the economy is doing well, cyclical stocks will do well. Same thing with typically consumer discretionary names. Cyclicals are doing very poorly. The underlying market is signaling a recession is coming, and almost day by day, it's signaling a harder recession is coming. And the markets are fooling everyone right now because it's so concentrated. What I have here is the chart of the NASDAQ in dark blue up top, and the chart of the average kind of stock, or this isn't the average stock. This is the advanced decliner line. So it's basically showing you the breadth, meaning when the markets go up or down, you should see this line basically follow what the markets do. The more this bottom line outperforms, the higher this goes compared to the index, the more your average stock is going higher, right? Some periods that you have seen this really outperform was in the beginning of January 3rd, really the start of this year. you've seen a lot of stocks start to do well. The index did well, but a lot of other stocks did well also. Last time you've seen good breadth as well was right here, where the NASDAQ only rallied a little bit around March 28th. And the average stock was accelerating during this period in time. What you've seen from really mid-April, around April 13th, is most stocks are declining on a day after day basis. But the index has done nothing but go straight up since then. And you've seen this line basically trend straight downward. So why this is a problem for hedge funds is because in 2021, when hedge funds were getting blown up and literally causing the banks to lose billions of dollars, I believe JP Morgan lost $5 billion from the Archegos fallout. They could afford to lose it a little bit more than something like Credit Suisse, which also lost almost $5 billion. But what that did is make it so if you take out a short position in AMC, you cannot pledge an average stock as collateral, because look what average stocks have done. I mean, for good reason. They've fallen. That collateral value just gets chipped away, and there's too much risk if you're a lender of AMC stock. So they have to pledge high quality collateral. Trust me, there's been so many rule changes, I can't quote the exact rule change. It is DTCC 501, maybe, I want to say. It was back in the summertime of actually 2022 when this rule change happened, almost a year ago now, where collateral got haircuts. I know you guys remember the collateral haircuts that was seen. Even high quality stocks seen collateral haircuts. But during that same rule change, stocks that were not rated A quality to AAA quality could not be pledged as collateral for risky stocks, for essentially meme stocks, because the risk here is that AMC or GME could 10x in value or 20 or 30x in value, and banks would get blown up, essentially was the problem. Well, when big tech, notice when I say when, not if, when big tech falls, that's going to be a massive problem for hedge funds and institutions, because yeah, sure, they've been shorting these mid and small cap names that can continue to decline, but at this point, you've exhausted those potential shorting gains. At this point, it's the big tech that's going to fall and come in alignment with the markets. If not, two ways this plays out. Either big tech falls and catches up with where markets are really at, and then everything bounces from the bottom, or small and mid cap stocks, banks, the whole market catches up to big tech. And the higher big tech goes, the less likely that looks. So either you want to be in small and mid cap stocks right now to wait for that catch up, or you don't want to be a part of big tech really at all. And maybe buying some puts on big tech would be the play there. If you guys want access to all of my trades in real time, link down below in the description of this video. But nonetheless, when those big tech stocks fall, it's going to put a lot of pressure on the hedge funds. And there's a reason why stocks tend to short squeeze at lows in the market. It's because liquidity does dry up. Now, another problem that I personally see hedge funds having right now is they are massively short on a stock that has fallen a lot. AMC has fallen a lot. And the specific problem here is that when AMC does tend to fall a lot, it tends to rally big, right? After these sell-offs, you tend to rally very aggressively. And right now is really, in theory, when you would want to be buying AMC. When people seem to not like the trade, when people are relatively negative on the trade, when there's not a lot of volume in AMC, that's when historically you have wanted to buy AMC. Low volume is when you want to buy AMC, because when AMC's volume does spike, that's when you see the rally in AMC, or really in any name for that matter. Low volume heading into high volume typically gives you rallies, unless it's like really bad news. And I think a power that a lot of people don't understand with AMC compared to other names is everyone knows about the stock. Everyone knows about the trade. Everyone's going to want to be a part of this trade when it ultimately does happen, when it starts. People are going to flood into AMC again. In my mind, it's not a question of if, but when. So I think being short on this name right now just doesn't make a whole lot of sense. Another problem that I have, or I think hedge funds are going to have, is GME. GME has actually been doing pretty well this whole time. Now, GME is going to be reporting earnings here in, it looks like, after hours, June 7th. So, GME is really at a breakout level. GME could help lead the way higher for something like AMC. Now, GME, if they report profits on earnings, that's going to be really what sends GME stock up much higher. And I think that lifts the whole sector up at that point. If you look at GME, clearly at a breakout point. I mean, I don't know what else you could really say about it. It's at that level. 200-day moving average coming down. If you do break that heading into earnings, that's going to be a solid sign. But if not, if GME leads to another profitable quarter, the stock's going up 50% or more from here. You're going to get a short squeeze at that point. And I think that does positively affect AMC as well. So those are the problems, some of the problems. I mean, we could make probably an hour and a half video on the problems that I see hedge funds having right now. With AMC, these are some of the ones that I think about all the time on a daily basis. And I kind of wanted to just lay it all out to you, or some of it, of kind of why I'm bullish, and why I think hedge funds are ultimately screwed when it comes down to it, guys. So that is going to do it here in this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. You guys have a great weekend, and I will see you in the next one.